to find a multi-bagger? It's simple. If the stock keeps on going up, it is a multi-bagger, and if the stock keeps on falling down, it is a bad stock, right? That is it. That's the entire strategy most of the retail investors use before buying any stock. I know it sounds ridiculous, but let me tell you an incident which happened with me a few months ago. So one of my subscribers emailed me and said that he wanted to invest in IDFC First because it is a multi-bagger stock. Why? Because he watched the stock rally from 28 rupees to 70 rupees, and only when it hit 90 rupees, he felt like he's missing the rally. And then he finally bought the stock purely because of some news anchor thinking that the stock will keep on rallying forever. But then the story flipped. From 100 rupees, the stock did not just slow down. It collapsed from 100 to 80, 80 to 70. Panic took over. He sold everything, calling it a bad stock after watching a 35 to 40% drop burn his confidence. And after a few months, the stock has climbed back up and he feels the sting again, thinking, I should have held the stock. This could have been my multi-bagger. So this roller coaster of emotions is not just a story of IDFC First Bank. It is a psychological trap which most of the investors fall into. See, the reason why I am telling you this story has everything to do with a fundamental shift happening in the stock market right now. Most of the investors won't understand it today, but mark my words, 5 years from now, every serious investor will talk about this exact point. And the ones who understand it early will make a lot of money. And now let us look at the bigger picture. So macroeconomically, the world is drowning in debt. Just look at this number. US, India, China, debt is increasing every year.
The world is in debt.
America is $37 trillion in debt.
We haven't seen this kind of debt since the Napoleonic Wars.
U.S. national debt has reached a record $37 trillion.
We're gonna be broke.
And when the world runs on borrowed money, chaos becomes normal.
Hundreds of thousands of Americans have joined nationwide protests against President Donald Trump's trade tariffs.
Still in Europe, rising inflation rates prompt mass protests.
Where demonstrators fill the streets demanding the impeachment, conviction, and removal of President Donald Trump.
And chaos creates volatility. And volatility means that the markets don't just go up. They shoot up and then they crash down again with the same aggression.
More than $1.5 trillion have been erased in a matter of days. The US stock market is bleeding.
Because shares on Wall Street have slumped today, led by the NASDAQ, which plunged by as much as 4% at one point earlier.
And this kind of pattern has already started gripping our markets as well. But here's the twist. Big players love this volatility. They are absolute masters of making money out of your fear and your excitement. They know exactly how to trigger your emotions, how to make you greedy at the top and how to make you panic at the bottom. So how does this manipulation happen? How do they pull the strings while retail investors think they are in control? So that is exactly what I am going to break down for you in the simplest, clearest and most eye-opening way possible in this video. And I like to explain with a few real life stock examples. So we will be discussing a few stocks as well. See, the number one way in which big investors are fooling you is by taking money out of your pockets through news manipulation. It is one of the oldest techniques in the book. And to understand this game, we need to travel back to 2021. The paints industry, a sector dominated by a titan, Asian Paints. For decades, it was the undisputed king, holding nearly 60% of the market. But then a new challenger appeared. Grasim, a part of Aditya Birla Group, announced its entry into the paint sector with a brand called Birla Opus with a massive investment of 5,000 crores. The market was a little concerned, but Asian Paints seemed secure. But in 2022, the challenger doubled down. Grasim announced that it was doubling its investment to a staggering 10,000 crore rupees. And that is when the story changed. Suddenly, news channels, social media, and influencers started singing the same tune. The end of an era for Asian Paints. Grasim's entry will destroy Asian Paints' market share. Asian Paints has lost its shine. The stock was very badly downgraded and a wave of fear was unleashed. And what did the retail investors do? They panicked. As the stock price fell, they sold their shares in one of India's most fundamentally strong companies, booking heavy losses. So now let us have a look at what was really happening behind the scenes. And here is the proof. In March 2023, the public shareholding in Asian Paints was 20.23%. And as the fear campaign reached its peak, the retail investors sold. And by September 2025, the retail holding or the public shareholding had dropped to just 14.09%. So who was buying the shares that they were selling? The big players, the domestic institutional investors. Over that same period, their holdings skyrocketed from 9.96% to 21.50%. They were quietly buying every share that the retail investors were throwing away in fear. They bought at the bottom when panic was at the peak. And then what happened? Fast forward to today, Asian Paints still holds majority of the market share of 52%, and the CEO of Birla Opus recently resigned, and the market now believes that the aggressive disruption is over for some time. And Asian Paints, it started rallying again. And I am not talking in air. Asian Paints rallied 24% in the month of October. And just 2 quarters ago, DIIs had increased their stake from 13% to 21%. So here the big players bought the shares at a discount and made a fortune. And this is not just a one-time story. It is a playbook. It has happened before and it will happen again. You will be manipulated by the news to sell your best assets at the worst possible time. And this whole Asian Paints episode tells us one thing very clearly. New investors don't lose money because of bad stocks. They lose money because of bad timing and panic. And that is precisely why we have created the RangaOne Basic Plan. It is for new investors who want simple, professional grade guidance without any confusion. RangaOne Basic Plan, you get 10 to 12 quality stocks, 5 short-term or swing trades, clear entry and exit points with a target, real-time market updates. So you know what to do, when to do it and why. No noise, no fear. Just clean, actionable research to grow your money the right way. Visit rangaone.finance if you want to know more about the RangaOne Basic Plan. So coming back to the playbook, how do you protect yourself from this game? How do you respond and not just react? See, there are these 2 simple yet powerful rules which one can follow. Rule number 1, become a detective, not a spectator. Don't just listen to the news, investigate the numbers. And now let us go back to IDFC First Bank story when the stock was falling and the news was negative. At that time, what were the financials saying? Go and check the profit and loss statement. Was the revenue increasing? Yes, 100%. Was the profit increasing? Yes, it was increasing. But then there was a sudden dip in September 2024. And the news channel will stop over there. But you as a detective must ask, why? So you will find the answer in their quarterly report. This dip was due to a change made in the regulations by RBI higher provisions. So this was not a business problem. They were not committing a fraud. It was a temporary industry-wide problem. And in the following quarters, the profits did not immediately started hitting new highs, but they were improving. And this shows that the company has the strength to bounce back. So when you see a bad quarter, don't panic sell, pause. And if you are doing SIP, maybe stop doing SIP for the next few months or just slow down. Watch the next 2 to 3 quarters. And if the business is showing resilience, then that is your signal. That is when you can consider investing more and for the long term. And IDFC First Bank is available at 21% discount now. Rule number 2, judge a business, not the stock price. Now this is one of the hardest rules, but it is the most important. People judge a stock by its price movement. If the stock is going up, it is a good stock. If it falls, it is a bad stock. And this thinking will always lead to losses. A classic recent example is of Varun Beverages. When Campa Cola was relaunched, the news line was filled with stories like Mukesh Ambani will destroy Varun Beverages. A price war is coming that Varun Beverages cannot win. So the retail investors heard the news and looked at the falling volatile stock price and thought, it is a bad stock now. But what was the business doing? The revenue was hitting all-time high, the profits were hitting all-time high, and crucially, the operating profit margins were still strong. The business was thriving even with the new competition. So I am still of the same view. VBL available at 30% discount is a very rare chance to buy. In the future, we might not get the stock at this level. So when a fundamentally strong business like this is available at a discount due to market noise and fear, it is not a crisis. It is an opportunity, because the only people who made life-changing money from stocks like these are the ones who had the patience to see beyond the noise. So the moral of the story is simple. Stock market is an instrument for transferring money from the impatient to the patient. News will be manipulated, your emotions will be targeted, but the news only manipulate those who chase the stock price. So if you learn to read the story of the business, if you trust the numbers more than the noise, then you won't just survive the game, you will win it. And at RangaOne, we teach you to do exactly that. Not just survive, but win it, because your growth is our priority. So this was Sanika from RangaOne Finance, and I will see you very soon in the next one. Till then, bye-bye.